Welcome back to Backtested Hub, where we strip away the hype, ignore the self-proclaimed trading gurus, and let the hard historical data do the talking. Every day, you see claims of secret formulas and indicators that promise to turn a few $100s into millions overnight. But let's be honest with ourselves. If those systems actually worked, why would anyone sell them for $99 in a PDF? The reality of systematic trading is far less glamorous, but infinitely more reliable. It is about finding a statistical edge, understanding its structural limitations, managing your downside risk, and executing it with absolute, emotionless discipline. Today, we are putting one of the absolute foundational pillars of classical technical analysis to the test: the dual moving average crossover strategy, specifically utilizing the 10-day and 30-day exponential moving averages. We are going to run this battle-tested trend-following model through a rigorous 10-year backtest on one of the most liquid, high-growth tech giants of our era, Alphabet Incorporated, ticker Google. No cherry-picked dates, no hindsight bias, just pure, unadulterated cold hard data. Let's find out if this classic strategy can actually beat a simple buy-and-hold approach over a decade of market ups and downs. Before we look at the performance, we need to understand exactly how this mechanism functions under the hood. The dual moving average crossover is a classic trend-following framework. Instead of trying to predict the exact bottom or top of a market cycle, which is a mathematically losing game over the long run, this strategy aims to capture the fat middle section of an established trend. We use two specific lines: a fast-moving average and a slow-moving average. In our case, we are employing the 10-day and 30-day exponential moving averages, or EMAs. Unlike a simple moving average, which treats every single day in its window with equal importance, an exponential moving average places a higher mathematical weight on the most recent price data. This means the EMA reacts much faster to sudden trend shifts, reducing the lag that often plagues traditional trend-following systems. By plotting the fast 10-day EMA and the slower 30-day EMA together, we create a dynamic system that filters out daily market noise while still remaining sensitive enough to capture emerging macro trends early on. Let us zoom in and look at the exact mechanics of a buying trigger, often referred to in technical analysis as a golden cross. In our specific model, a buy signal is generated the very moment the fast-moving 10-day EMA crosses above the slower-moving 30-day EMA from below. Why does this matter? Mathematically, it tells us that the short-term momentum of the stock is accelerating upward at a faster rate than its medium-term historical average. This is not just a random line crossing. It represents a fundamental shift in the supply and demand balance of the asset. Buyers are becoming increasingly aggressive, willing to pay higher prices today than they were over the past month. When this crossover occurs, our algorithm immediately executes a long position at the next market open. We don't wait, we don't hesitate, and we certainly don't try to guess if the price is too high to buy. We simply follow the mathematical signal. But a trading strategy is only as good as its exit engine. Buying is easy. Knowing when to cut your losses or lock in your hard-earned profits is where most retail traders completely fall apart. This is where the death cross comes in. In our model, we exit our long position and return entirely to cash the moment the 10-day EMA crosses back below the 30-day EMA. This crossover indicates that the short-term upward momentum has completely exhausted itself, and the sellers are reclaiming control of the price action. By liquidating our position immediately upon this crossover, we protect our trading capital from catastrophic, multi-month bear markets. We don't hope for a rebound, and we don't hold through painful drawdowns. If the trend is dead, we exit. This exit mechanism is designed to cut losses quickly while letting our profitable trades run as long as the upward trend remains intact. This trend-following philosophy didn't just appear out of nowhere. It traces its roots back to legendary traders like Richard Dennis and his famous turtle traders in the 1980s, as well as systematic pioneers like Ed Seykota. These market wizards prove to the world that you do not need to know where a stock is going tomorrow to make money. You just need to follow the path of least resistance. In the era before high-frequency computers, traders would manually calculate these moving averages on graph paper. They realized that while they would experience many small, controlled losses during choppy, sideways markets, the massive returns generated during prolonged, multi-month bull markets would more than compensate for those paper cuts. This philosophy has survived decades of market transformations, from the trading pits of Chicago to the digital algorithms of modern Wall Street firms. So, why did we choose Alphabet Incorporated, ticker Google, as our testing ground for this classic trend-following strategy? Google is an absolute powerhouse of the modern digital economy, characterized by massive institutional liquidity, strong secular growth trends, and high volatility. For a moving average crossover strategy to succeed, it requires a stock that actually moves. If you run a trend-following system on a flat, slow-moving utility stock, you will get chopped to pieces by transaction costs and constant false signals. Google, however, has experienced massive, sustained macro trends driven by mobile search growth, cloud computing expansion, and more recently, the artificial intelligence revolution. But it has also faced significant, painful corrections due to regulatory pressures, antitrust lawsuits, and macroeconomic downturns. This combination of powerful bull runs and deep corrections makes Google the perfect test subject to see if our 10-30 EMA strategy can successfully ride the waves while avoiding the crashes. Let us break down the exact parameters of our historical simulation so you can replicate this yourself if you wish. The backtest runs over a massive, comprehensive 10-year period starting on July 1st, 2016, and ending on June 30th, 2026. This decade-long window is incredibly robust because it covers an extraordinary variety of market regimes. It includes the steady, low-interest rate bull market of the late 2010s, the extreme panic of the 2020 pandemic crash, the explosive liquidity-driven post-pandemic recovery, the brutal inflation-driven bear market of 2022, and the massive AI-driven technology boom of the mid-2020s. We assume a starting capital of $100,000, with 100% of our equity allocated to each trade. To ensure the utmost realism, we have factored in transaction costs and slippage for every single trade. We do not assume perfect execution. We assume real-world market conditions where every trade costs money to execute. Now, let us reveal the truth. Let us look at the performance of the dual moving average crossover, 10/30th day EMA, over this 10-year journey on Google. When we plot the growth of our initial $100,000 portfolio, we get a clear picture of how systematic trend following behaves in the real world. Over the entire backtest, the strategy generated a total return of plus 19.2%, translating to a compound annual growth rate, or CAGR, of plus 1.8%. In comparison, a simple, passive buy-and-hold strategy on Google delivered a total return of plus 904.7%, with a CAGR of plus 26.0%. Take a close look at how the two curves diverge. You will notice that during periods of steady, sustained upward trends, our EMA crossover strategy tracks the buy-and-hold curve closely, capturing the bulk of those massive gains. However, the real magic, or the real danger, of the strategy lies in how it behaves during major market turning points. To truly understand these results, we have to look past the headline return numbers and dissect the granular trading statistics. Over this 10-year backtest, the algorithm executed a total of 36 trades. This trade frequency is incredibly important. It shows that the strategy is relatively slow and deliberate, avoiding the trap of overtrading. Out of these trades, our win rate was 41.7%. Now, to an inexperienced trader, a win rate of 41.7% might sound shockingly low. You might think, how can a strategy be profitable if it is wrong more than half the time? But this is the core secret of professional trend following. You do not need a high win rate to be highly profitable. The key is asymmetrical risk to reward. When this strategy is wrong, it cuts the loss quickly, resulting in small, negligible drawdowns. But when it is right, it holds the position for months, capturing massive multi-100% gains. The large winners easily pay for the frequent small losses. Now let us talk about risk, because return without risk context is completely meaningless. The maximum drawdown of our dual moving average crossover, 10/30th day EMA, reached 35.4% during this 10-year backtest. Drawdown represents the largest peak-to-trough drop in our portfolio value, measuring the intense psychological pain a trader must endure to execute this strategy. Compare this to the maximum drawdown experienced by passive buy-and-hold investors during the same period. By looking at the drawdown profile over time, we can clearly see how the EMA crossover strategy acts as a protective shield during severe market crashes. When Google entered prolonged bear markets, our fast 10-day EMA quickly crossed below the 30-day EMA, taking us completely out of the market and preserving our capital and cash. While passive buy-and-hold investors were watching their portfolios plummet and panicking, our systematic model was sitting safely on the sidelines, waiting patiently for the next clean entry signal. To gain an even deeper understanding of this system, we must examine the annual performance breakdown. Year-by-year analysis reveals the true character of trend following. You will notice that in highly directional years when Google established a clean, powerful, uninterrupted upward trend, the strategy performed exceptionally well, sometimes even outperforming buy and hold due to leverage or precise timing. But look at the years where the market went sideways, chopping up and down in a broad range. In those specific years, the strategy suffered what we call whipsaws. The 10-day EMA would cross above the 30-day EMA, triggering a buy, only for the price to reverse days later, triggering a sell loss. This cycle of buying high and selling low repeatedly during range-bound markets is the primary tax you pay for the protection the strategy offers during major market crashes. This brings us to the critical, honest limitations of the dual moving average crossover strategy. We do not sugarcoat things here on Backtested Hub. The biggest weakness of any moving average system is its inherent lag. Because moving averages are calculated using historical price data, they are lagging indicators. By definition, they will always buy after the bottom has already been established, and they will always sell after the top has already passed. In highly volatile, mean reverting, or sideways markets, this lag can result in a devastating series of consecutive losses. If a stock is bouncing rapidly between support and resistance, this strategy will consistently buy at the top of the range and sell at the bottom. Furthermore, during a sudden, violent market crash, like a flash crash, the lagging indicators may not react fast enough to protect you from the initial sharp drop, meaning you still bear some immediate downside risk. So, how can we take this classic, simple framework and improve it for modern market conditions? Professional quantitative traders rarely use a simple moving average crossover in isolation. Instead, they combine it with other non-correlated indicators to filter out false signals. For example, you could integrate an average directional index, or ADX, to measure the actual strength of the trend before taking a crossover signal. If the ADX is low, indicating a weak or sideways market, you ignore the crossover. Alternatively, you could incorporate volume analysis, ensuring that a golden cross is supported by heavy institutional buying volume before committing capital. Another highly effective improvement is implementing an ATR-based trailing stop loss, allowing you to lock in profits during a massive run without waiting for a lagging, slow-moving average crossover to exit your position. At the end of the day, the 10/30th day EMA crossover strategy is not a magic bullet, but it is a powerful, rule-based framework that removes human emotion from the equation. It forces you to cut your losses quickly and lets your winners run, the two most fundamental laws of successful trading. If you want to build your own systematic trading business, you must treat it like a business. Understand your numbers, accept your drawdowns, and execute your plan with absolute consistency. What asset or strategy would you like us to backtest next? Let us know in the comments below. If you appreciate honest, data-driven backtesting without the marketing hype, please hit the like button, subscribe to Backtested Hub, and turn on notifications. Your support helps us keep producing unbiased quantitative research. Until next time, keep analyzing, keep backtesting, and let the data guide your journey.